If I had to learn trading from zero again, the first thing I would change is this. I would stop looking for a strategy so early. Most beginners think the strategy is the missing piece. They think if they can find the right setup, the right indicator, or the right entry method, everything else will start to make sense. But that is not usually how trading breaks people. Most traders get stuck because they have no process. They switch markets, time frames, indicators, and styles. They try scalping before they can manage pressure. They risk real money before the rules have been tested. Then when a trade wins, they think they are improving. When a trade loses, they think the strategy is broken. Both reactions are too simple. A win does not prove you traded well. A loss does not prove the idea was wrong. If I were starting again, I would build the learning path in a different order. First, choose the trading style. Then learn risk. Then study price from first principles. Then focus on one market and one primary time frame. Then test, journal, and review before adding real pressure. This is not the fastest looking path, but it is the cleaner path. And in trading, clean decisions matter more than exciting ones. The first mindset shift is not motivational. It is practical. Stop measuring your learning by how badly you want the result. When a beginner brings too much pressure into the chart becomes hard to read clearly. They stop asking useful questions and start asking desperate ones. Is this finally the setup? Should I get in before it moves? What if I miss it? That mindset makes you react to candles instead of reading the market. The better question is not, how can I get something from this chart? The better question is this a clean decision? Do I know the context? Do I know where the idea is wrong? Do I know what I am risking? Do I know whether this setup is part of my tested plan? If those answers are unclear, the best decision may be no trade. That is not weakness. A no-trade decision is still a trading decision. So I would not start by trying to trade more. I would start by trying to become less random. Before I learned a strategy, I would choose my trading style. Not because one style is better, because each style demands a different version of you. Scalping demands speed, screen time, and emotional control. Day trading still requires focus during active market hours. Swing trading gives you more time to plan and review. Position trading is slower and built around bigger market ideas. Most beginners are attracted to the fastest style because it looks exciting. But the fastest style often requires the most control, and that is exactly what beginners have not built yet. If you have limited screen time, forcing yourself into scalping may create more noise than skill. If you cannot sleep with a trade open, swing trading may not fit you yet. If you get bored waiting, position trading may make you break your own plan. So the question is not, which style looks best? The question is, which style can I practice properly without becoming impulsive? If I were starting again, I would probably begin slower than I wanted to. More time to think, more time to mark levels, more time to review. Speed can come later. Clarity should come first. Before I judged any strategy, I would learn two numbers: risk to reward and win rate. A lot of beginners only ask, how often does this setup win? That question matters, but it is incomplete. A method can win often and still be weak if the losses are too large. A method can lose more often than it wins and still be worth studying if the winners are meaningfully larger. But do not turn risk-reward into fantasy. The market does not care about the ratio you want. The chart has to support it. This is where beginners start forcing trades. They see a clean reaction candle. Then they push the target far away and squeeze the stop too tight so the trade looks better on paper. That is not risk management. That is editing the plan until it feels comfortable. The stop belongs where the market proves the idea wrong. If the idea is based on demand holding, invalidation is connected to demand failing. If the idea is based on structure shifting, invalidation is connected to that structure failing. Invalidation is not where you want to lose less. It is where the setup no longer makes sense. Now ask the other question. Where is the next opposing force? If you are buying and supply is close above, the room may be limited. If you are selling and demand is close below, the room may be limited. This is why a beautiful setup can still be a bad trade. The candle can be right, and the entry can still be poor. Every trade idea needs a reason, an invalidation point, and enough room to be worth testing. Without those, you are not evaluating a strategy. You are reacting to movement. Next, I would learn from price first. Not from memorizing indicator signals. Not from collecting candle pattern names. From price. Every chart is built from buying and selling pressure. Price moves because one side is more aggressive, one side fails to continue, or one side is forced to exit a weak position. If you use an indicator, fine. But you should still understand what price is doing underneath it. If you use a candle pattern, fine. But the candle is not the setup. The candle is only evidence. Evidence of what? That is the real question. Let us say price sells into a demand area. There is a prior low nearby. Sellers push price below that low, and for a moment the chart looks weak. Late sellers may see that breakdown and assume control is shifting lower, but then price rejects the breakdown and closes back above the level. Now ask the better question. What did sellers fail to do? They failed to hold price below the low. Then ask, did buyers do enough to matter? If price only bounces weakly and stays inside the same messy range, there may be no clean decision. But if buyers reclaim the level and break a nearby swing high, now the story changes. Location came first, reaction came second, structure came third. That is price action, not a candle name. A candle in random space is just movement. A candle at a meaningful location, with pressure, structure, invalidation, and room becomes useful information. If I were starting over, I would ask less often, what is this pattern called? And more often, what did one side try to do, where did they fail, and what would prove my read wrong? After that, I would narrow everything down. One market, one strategy, one primary time frame. This may feel restrictive, but restriction gives you feedback. If you trade crypto one day, Forex the next, stocks after that, then switch from breakouts to reversals to indicators, you are not building skill. You are collecting experiences that do not connect. You need repetition. Repetition shows what actually repeats and what only looked obvious after the fact. But focus does not mean tunnel vision. Your primary time frame is where you make the decision. The higher time frame gives you context. Here is the chart question. What is this smaller setup moving into? On a lower time frame, price may pull back and give a strong bullish reaction. If you only look at that chart, the idea may feel obvious, but now check the higher time frame. Price is pushing directly into supply, where sellers previously overwhelmed buyers. The lower time frame candle may still be strong, but the room is limited and the location is weaker. That detail changes the entire read. Execute on your primary time frame, but understand the higher time frame story. If the higher time frame is unclear, slow down. If the lower time frame setup is pushing into a major opposing area, do not force it. If the chart does not tell a clean story, no trade is a valid answer. Now comes the part many beginners rush. Demo. Most traders treat demo like a waiting room before real trading. They click around, take random trades, maybe have a good week, and then assume they are ready. That is not what demo is for. Demo is where you prove the process, not the outcome of one trade. The process. Can you follow the same rules when the chart moves quickly? Can you skip trades that almost fit but do not fully qualify? Can you define invalidation before the trade? Can you use the platform without making basic execution mistakes? If you cannot do those things on demo, real money will not make you clearer. It will usually make you more emotional. I would not go live just because I felt ready. Feeling ready is too vague. I would want written rules, a tested sample, screenshots, notes, and a record of trades I should have skipped. Here is the no-trade rule. If the strategy is not written, tested, journaled, and reviewed, do not risk real money on it yet. That may sound strict. But trading without a tested process is not confidence. It is exposure. The next step is journaling. And I do not mean writing, I felt good, or I felt bad. That is not enough. A useful journal shows what you saw, what you risked, where the idea was wrong, what happened, and whether you followed your rules. Most beginners only review losses. That is a mistake. Losses can teach you, but wins can fool you. You can take a bad trade and still win. If you do not review it, you may repeat the mistake with more confidence. You can also take a good trade and lose. If you review only the outcome, you may abandon a valid idea too early. The journal separates outcome from decision quality. Imagine this chart. Price is moving sideways in a messy range. Candles overlap. There is no clean direction. Then a strong bullish candle appears near the middle of the range. It looks exciting, but look closer. Resistance is close above. There is no clean structure break. The invalidation is unclear. The candle appears in the middle of noise. If you only write lost trade, you learn almost nothing. If you write strong candle, bad location, nearby resistance, no structure confirmation, unclear invalidation, now you have a pattern you can fix. You are not just tracking trades, you are tracking behavior. After enough review, you may notice that most weak trades come from the same mistakes. Chasing a large candle, trading into an opposing level, moving invalidation, or taking setups that almost fit. That is the work. Not finding more setups. Removing the weak ones. There is one final idea I would understand much earlier. Small edges need survival. If your process has a small edge, you still need time to measure it. You need enough trades to see whether the idea is real and risk small enough that one bad week does not damage your ability to keep learning. If you risk too much too early, every trade becomes emotionally heavy. You stop following the plan. You move stops. You close early. You turn one mistake into 3. Then you blame the strategy. But the strategy was never tested cleanly. The process was drowned by risk. So if I had to learn trading from zero again, this is the roadmap. Choose the trading style first. Learn the platform and risk controls. Understand risk to reward and win rate. Study price from first principles. Focus on one market, one strategy, and one primary time frame. Use higher time frame context. Test the rules on demo. Journal wins and losses. Protect your ability to keep learning. The core truth is simple. Do not start with the strategy. Start with the process. Without risk, context, invalidation, and review, a strategy is just a guess with rules around it. Process first, strategy second, real risk last. A trade idea is not complete until context, invalidation, risk, and review all make sense. Before you move forward, ask, what style fits my life? Do I understand the platform? Do I understand risk, reward, and win rate? Can I explain the price action? Am I focused on one market, one strategy, and one primary time frame? Did I check higher time frame context? Are my rules tested on demo? Do I journal wins and losses? Where's the idea wrong? If the setup is unclear, can I choose no trade? If this helped, save the checklist.